Before I ever go into a market, I'm going to do a quick analysis, right? And really, I'm going to focus on 3, maybe 4 things if I feel like I need another level of evaluation. The first thing I'm going to look at, which immediately disqualifies the state of California, is it resident friendly or is it landlord or investor friendly? Usually the easiest way to get a head start on this evaluation is it a Democratic state or is it a Republican state? Red states are just usually more investor friendly than they are resident friendly. Not to start a political conversation, but that's a good way to kind of make sure your rental properties are secure. So start there. We want to start on the state level. Hey, are we investor friendly or are we renter friendly? And then from there, we start looking at the individual cities. And the first thing I'm going to look at,
would you just automatically disqualify if it's tenant friendly, just default regardless of the numbers?
I would not. What that initial evaluation does is it allows you to at least know what you're getting into, right? One of the states that I invest in is Connecticut. It's a very blue state. They have horrendous laws for investors in terms of, having rights to your own property. So what does that mean? Well, I know that up front. I'm aware of that. I've done my research. So, I will do things like charge the absolute maximum of earnest money on, exactly. So deposit. So I charge 2.5 months deposit, right? So, things like that, I have my attorney write every single lease, right? So I'm very diligent on what I do up front to make sure that I don't get burned on the back end, right? Whereas in a state that's more investor friendly, then I don't need to be that secure or that thorough ultimately. So it's not a killer, but it's a good place to start.
Okay, cool. Yeah, thanks.
Yeah, absolutely. The next thing I'm going to look at is rent to price ratio, right? I'm going to put myself in a position where I want to see the affordability of the homes in comparison to the amount of rent that I can actually get for that property. And I usually keep it nice and simple, right? Is I will go and look at what the average home cost is for a 3-bedroom, 1-bath property, compare it to the average rent cost for a 3-bedroom, 1-bath property, right? That allows me to easily measure what the rent to price ratio is. All right. And, the better the rent to price ratio, the more affordable the homes are for me to buy in comparison to the large amount of rents I can get from a resident that I can put in that home, right? That instantly is kind of my first trigger on, hey, can I make some cash flow in this market, right? Can I get some real income coming in this market once rates come down, and can I get this property to cash flow from the beginning? Does that make sense?
So can you give me an example with numbers? Let's say, I'm just looking at my market. In Indiana, we buy 3-bedroom, 1-bath. They typically rent anywhere from $1,200 to $1,500, $1,600, depending on the neighborhood. So what would you look at? Let's say if your rent is $1,300, right?
Yeah.
What does the mortgage? Yeah.
I'll show you guys exactly how it works. Can I share my screen? This is what it's going to look like for you. All right. Price to rent ratio here. So, we'll just use this general example is, if our monthly rent on a 3-bedroom, 1-bath is a gross number of $1,000, so it's $12,000 annually, right? Our average home price in that market's $125,000. That gives us a price to rent ratio of 10.4%, right? And here's kind of our ranges, right? So the higher this number is right here, right, the lower likelihood that we are going to be able to cash flow on a property in that given market, right? My market in San Diego is way higher than 21. Whereas, I think, Shrab, what you had said, Indiana's probably going to fall in that ideal 10 to 15 range, right?
Yep.
This is where you have the most likelihood of getting really good cash flow and finding quality deals in that market. So for me, price to rent ratio is kind of my first indicator of, hey, can I cash flow in this market, right? And if the answer is yes, great. Now the next thing that I really want to do is I want to make sure that the rent that I'm collecting, right? Because there's what are called paper returns and actual returns, guys, right? Paper returns are what these are, right? You can get $100,000 a month for a home, but can the renter actually afford that? And the way that we make sure that the renter can actually afford this is figuring out what are the economics of a given city, right? What are the drivers in that particular city that keep people employed? So the next thing I'm going to look at after I look at, red state, blue state, price to rent ratio is going to be our socioeconomic anchors, right? What are the job suppliers in that market? And I think people get really confused really quickly in terms of what an actual job supplier means, right? A job supplier is not the Home Depot or the Walmart in the town, right? It's what provides substantial economic stability to a given region or to a given city. And that would be like a Fortune 500 company. I like using Memphis, Tennessee a lot because of their socioeconomic anchors as an example. FedEx World Headquarters, right? The largest distribution and transportation airport in the world. The Mississippi River, a military base, Nike distribution plant, right? Just based on Memphis's location in the United States, pretty much everything that goes north, south, east, west in this country that's shipped stops in Memphis, Tennessee, right? So when you look at transportation and shipping, is that affected by the economy? Yes. Is it affected by the economy as badly as, let's say, tech? No. Is it affected as badly as the economy as, let's say, tourism? No, right? So we want to find these job suppliers that provide long-term stability, right? If you can find a state capital that fits within inside of these criteria, that's great. Why? Because the state capital always gets the state's money before any other city, right? And there's state jobs, there's usually military in those areas, right? Cities that are strong with colleges, education, and healthcare, right? All of those things continue to move forward when we have a struggling economy, right? Places like Scottsdale, Arizona, or Orlando, Florida, or, well, Las Vegas is kind of slowly changing through this, but Las Vegas used to be a very good example of this. Great economies, rental properties look amazing there whenever the economy's doing well, right? But what's the first thing people cut out of their expenses when they're needing to tighten their belt? And that's vacations, right? They're pulling back from that. And that's when those economies start to struggle and you really start to see failures there, right? So we go from the state level to, pricing versus rents, and then to what is supporting me getting those rents on a monthly basis by looking at the socioeconomic anchors.
So when you're looking at this is great, by the way, John. When you're looking at this, let's say, the example that you gave of Memphis, how far out would you go from that, the social economic hub to buy your rental properties? Like 45 minutes, hour? Do you have any radius on how far out would you go?
Yeah, super good question. So I'll kind of give you, we'll do if you want, Shrod, I can just do a deep dive. I'll kind of show you what I look at in a city. Like I can pull Memphis up and we can walk through it.
That would be great.
Let's check this out.
Yeah, because I used to live in Chicago when I started investing in Indiana, and I did, I was living in downtown, and I said, okay, I'm going to invest within 45 minutes to an hour of where I live, and Indiana happens to be, within 45 minutes to an hour of downtown Chicago. So I'm curious, kind of what your thoughts are on that. How far out would you go from that socioeconomic hub?
Well, I love Indiana, and I know exactly what you're talking about. So,
are you investing in Northwest Indiana?
Yep.
Yeah, it's a great market.
So, give you an idea. We'll just use yours as an example since we like it, since I like it too.
Perfect.
So, Chicago, right? Illinois, the whole state's almost bankrupt, and they have awful, laws for investors, right? So, we want to stay on the right side of this line, which is Indiana, as you guys can see down here, right? But people that live in Chicago and Illinois understand that taxes are high, the economy's struggling, so they move over here. So now we need to say, okay, Chicago is a massive metroplex, right? Huge economy, right? Quality jobs at the end of the day. But how can we feed off of this city in a state or an area that has strong economics, right? So, you can go through here, and I'm just kind of using this as an example because I know this area pretty well, right? Anything from Gary, the whole way up to Michigan City, down to LaPorte. South Bend obviously has Notre Dame in it, right? We have Valparaiso, Crown Point, Maryville. So all of these areas right across the line, these are all LaPorte, maybe not so much, but definitely Michigan City. That's kind of a vacation spot for people from Chicago. But all this area right here is a supported economy from Chicago. So, these are all be quality places to invest that would have a strong economic foundation without all of the, bad extras that come along with an Illinois, right? And then South Bend and Elkhart are both really good college areas, right? If you want to do college rentals or get into that as well.